Hello and welcome to Investing Confidential. Well, as the title says, the U.S., to me, when you look at what's going on economically, what its current administration is trying to do, debasing the dollar, all of these trends, despite the stock market coming back. I mean, that was inevitable. I think we call that uh, last video when we saw the immense number of puts that were being bought was all time high. I mean, the market was going to bounce, and it bounced very solid. But again, the stock market, the S&P 500, the index is worthless instruments to look at. They don't mean anything because they don't represent the economy like they used to. It's a complete joke. So the I'm going to show you again what I think, where you're going to make money, other things that are other red flags that are rising fast. But again, I want to continue to go back to what is the only thing that's that important. I emphasize the tariffs are a sideshow. You're seeing that now. He's going to put tariffs. He's taking them off. He's going to put tariffs. He's taking them off. He's going to take It's not relevant. This is the only that's relevant. And the current administration, just like the Democrats before them, are not going to address this problem. And I will continue to show this. If you don't like it, turn the video off. 36.8, essentially 8 trillion. It's going to be 37 very soon. And by the end of the year, most likely it'll be 38 trillion. I mean, this is a disaster. And nope, and even with all that's going on, nothing's being addressed. Absolutely nothing is being addressed. And the bottom line, here's the issue. $3 billion per day just in interest. So your tax dollars, okay, you just April 15th, well, I'm on extension, but you filed your taxes this year. 3 billion every single day is going just to pay our debt. And if you look at it from a chart standpoint, okay, steadily rising slowly per day interest payment on the debt. But look what happened from the end of 2020, beginning of 2021. Look what happened. And this is a result. It's not Joe Biden's fault. It is, but it's not. Is that we got sucked on and were addicted to artificial low interest rates. Okay, I blame this on Ben Bernanke more than anything else. He's the fool, and yes, he's a fool, who had this theory of helicopter money. Just print money and throw it at the people, and you'll incite GDP, and you'll solve the problems. Well, despite since 2008 massive amounts of government money printing, throwing money at the economy, this economy hasn't grown. Hasn't grown the way it should be growing. We've thrown trillions upon trillions upon trillions of dollars. And what do we have to show for it? Low growth and a massive, massive increase in our interest expense, because inevitably it came back to bite us in the ass, and interest rates, inflation, interest rates rising, and boom, now we have this issue. And it's not going away anytime soon. And the 3 billion is going to become 4 billion. Just keep going higher. And it's you can see it here. You got our 10-year yield, which is the blue, and you got an interest expense. And as a percentage of public debt, you're going to see, as we saw during the great financial crisis, you're going to see this surpass the yield as a percentage of the public debt. This is a disaster. This is emerging market. This is Brazil. This is Argentina. This is Russia. These during crisis, the Asian crisis. This is what we saw. And should we be excited about financial assets in a country that literally is going bankrupt? I don't know. You tell me. Okay, so first quarter GDP came in. Okay, again, as I told you, these numbers are all a joke. The Bureau of Labor Statistics or the Bureau of Economic Analysis. These are literally just worthless organizations. They mean nothing because the way they get this data is so outdated that we don't even know who's giving us this information. But okay, we have a negative number in the first quarter. Makes sense. But as I said before, the real economy has been negative for 3 years. This is now we're seeing financial assets start to kick in. Right? As I told you, debasing the dollar, the currency, the stock market, the bond market, uh, all of these financial real estate, which I'll touch on a few. All these things are pointing to recession. And though we've had a recession for quite some time, Main Street's had a recession. Now Wall Street is starting to feel the pain with deflation and recession. And again, just the components here. The big components imports essentially are consumer, right? Now this is a little bit of an aberration because obviously um, people were importing a lot of stuff in anticipation of tariffs. Again, all of these numbers are kind of worthless to a certain extent. But the bottom line is the media focusing on the tariffs, which are a sideshow, but focusing on the wrong thing, has created problems. Has created problems. The confidence of the consumer is hit. But I want to focus on really showing how much of a joke this is because the number was 0.03 or some. I don't even, it doesn't really matter anymore. But this is what the Fed, the GDP now, which is one of the most partisan, garbage, uh, you know, um, indicators there is. Okay, they were they were expecting again for the first quarter a almost minus 3%. Minus 3%. These people are insane. People are insane. This is the Fed. This is the and these guys have been up. They started doing this about two or 3 years ago during the last administration, and everything was higher. They were always expecting better GDP, better GDP. Always wrong, but this is the way they operate. This is a partisan organization. These are liberal people who have worthless indicators. They look at the consumer, worthless indicator, and look how wrong they were. Right? Look how wrong they were. But the betting markets almost got it right. Betting markets were much closer. And I'm going to keep showing you this. The betting markets are a much better indicator than the actual government numbers. That's a fact. And because of the fear mongering that's going on and the focus of the tariffs, which are the wrong thing, here's the estimate for GDP for 2025. Okay, they're down at 1.4% for the entire year. This is the latest. Now, again, these are estimates. Most likely, Wall Street analysts. They're as worthless as the Fed. Most likely, it's going to be lower than this. Believe it or not, lower because Wall Street is totally clueless. And when you look at expectations, again, we can take this with a grain of salt because of numbers, but confidence. Again, focus on tariffs. Everyone's tariffs, inflation, everything's going to be higher. And of course, consumers are negative. But look how bad it is. We're talking about as bad as pandemic. Are we in the same environment as the pandemic? I don't think so. I don't think so at all. But the consumer is very, very concerned, rightly so, because the media and I have to blame the media on this, is focusing on the wrong thing. Financial media, regular media, they're focusing on the wrong things. And what should be focused on, if you're a stock market person, if you're looking at the markets in general, is earnings. I mean, the market is driven by earnings, supposedly. And look at these revisions. They're coming down hard, very hard, for the S&P 500, people's favorite index. Okay, this is serious. This is why it's this rally we've had in the short term can't hold. Earnings are coming down. And another reason to be concerned and looking at the US as kind of major problems is liquidity. Look at the liquidity of the S&P 500 futures, literally the most liquid instrument there is. Now, this is the COVID blip, like everything else was COVID, but we're almost at the COVID blip. We're gonna surpass it. There's no liquidity, folks. There's no money. Money's being squeezed. Okay, and this low liquidity on the most supposed liquid instrument, what is that going to cause? Manipulation, one way or the other. I think this rally has a lot to do with short covering, and a lot to do with, people can buy these futures and make them look good because the average underlying stock's not going up. We're back to the Mag 7 again. So liquidity is terrible. And then my favorite chart, I always talk about correlations. This is bad. Okay, looking at, again, let me explain what this is. This is TLT, which is bonds. You got S&P stocks, and you got DXY dollar index. So bonds, stocks, and the dollar index are completely correlated. That is really bad. You do not want those things which represent financial assets to be completely correlated. But that's the reality today. It's worse than COVID. Worse than COVID. What does that mean? That means that there's either a lot of panic, a lot of euphoria, but whatever it is, it's going to reverse. Something's going to reverse. Now, my prediction is the S&P is going to break hard against bonds, against the dollar. The dollar will continue to be weak, but S&P is going to break hard. Or the dollar is going to break down even more. But something's going to break. And this is a red flag, a major, major red flag for financial assets in general. So things are not going well. But now I'm going to talk about some specific things that are interesting to watch on the positive and negative side. Let's first talk about Mexico. As I said, I think Mexico is the biggest beneficiary of all this craziness going on. Now, this isn't exactly a positive chart for Mexico, but I look at it as positive. These are the little diamond blue are exports, right? Exports to the U.S. as a percent of GDP. So obviously Mexico is one of the top. Now Vietnam is a little bit. Vietnam, they're small, and then you have growth expectations from the IMF. The IMF is a joke. Okay, so whatever the IMF says, I'm going to fade. So IMF is predicting Mexico's going to have big problems. As you know, I completely disagree. I think Mexico's going to have a really good economy because of this when it all shakes out. So, despite the IMF, I am going to take the opposite side of this and say I think Mexico is going to have better growth than the expectations because I think the IMF is a complete joke. Okay, a complete joke. And look at Mexico's exports. Now you can argue with me. Oh man, this is basically because of the tariffs. Well, it doesn't matter what the reason is. The reality is this: Mexico this goes back, okay, to 2000. So let's say 10 years. Mexico is having its best export year in 10 years. That's very, very positive for the local economy. This is bringing in lots of dollars to the local economy. Again, continue to emphasize the Mexican market, Mexican assets. This is what you should be focused on. All else fails, you buy the EWW, the ETF. Okay, but Mexico is something you really need to have exposure to, especially on any kind of crazy weakness. Now, the next, so we've had the dollar take the hit. We had stocks begin a correction phase. Then they rally, but they're gonna go lower. Bonds are having its issues, and then the last asset from a financial asset standpoint that's about to take the hit is our old friend real estate, and it's very simple. For 5 years, the brokers have lied to us and said, "Oh, it's supply, supply, supply." When they caused this supply issue, but now there's no more supply issue. There's more houses on the market than there has been since before 2019, which was probably one of the lows. So when I would say that, especially in the Northeast, the real estate market was in a death spiral. Now we're worse than that. And it's a matter of time, as I told you. Real estate takes longer. Real estate goes real fast, pricing, but comes down. We're in the beginning of a long bear market in real estate, 3 to 5 years. The inventories are just going to rise and going to get worse. And look at some of my past videos. I can talk to you about specific country markets, the states. It's getting bad. And here, these are completed. Okay, so you got new homes being built. These are ones that are completed, it's supposed to be sold. They're not, they're sitting there. And look at it again. Surpassing the prior to COVID, 2018, 19. And I mean, this is combined with the other chart I just showed you, showing you we are in the beginning of a massive bear market. Now, if you try to sell your house in certain parts of the New York metropolitan area, you'll probably have no problem selling it. The rest of the country, but the hammer is going to come down in the Northeast, folks. It's going to come hard. Do we know the trigger? I don't know, but don't matter. The Northeast cannot operate in a vacuum. It can't. So bottom line is, so you have financial assets, stocks, you have bonds, you've got the currencies, and now you've got real estate. And real estate is the one that's not as liquid as the others, but very important part of a lot of reasons, of a lot of things, consumer confidence, a lot of things. But we're beginning to see this is the beginning of the end for the real estate market. A lot. I mean, I've been predicting this for quite some time, and by the way, if you don't live in New York or metropolitan area, my predictions have been correct on real estate. But New York has such a massive weighting that you're not seeing it, but it's happening everywhere. And as soon as New York tumbles, this is going to look so bad. So bad. But it's a positive, remember, because we're talking about the American dream, right? I hate to be sympathetic, but this is people have been, the main street, the working man has been priced out of the real estate market for many years. For many years, because hedge funds and others have loaded up on these things. They've been, built to rent, buying houses, renting them, because again, because of Ben Bernanke and all these morons at the Fed bringing rates down. Bottom line is, folks, things are coming your way if you're Main Street. There's going to be some volatility, but financial assets are toast, and there are things to look at outside the U.S., and that's where you should be putting your money. A large percentage of your money in bonds and outside the U.S. Other financial assets, the U.S. dollar, real estate, not so much. So again, investors, as always, be careful out there.